Okay, now we come to the fourth part of understanding derivatives, option trading. Fourth part. What is this? In this section, we'll be actually discussing more strategies. What I'll do is, first I'll run through some of the terminologies and how exactly it works. Later, practically, we'll see using Sensible how to actually we can build a strategy, which we'll be doing it in the next session. But now I'll be running you through some of the sessions. So what we'll be learning in this session, the most important is first is payoff. When does an option strategy pay off? When are you actually making money? So that is what we will understand, where is it paying off? At what point that, you actually your strategy is making money is what we will understand. And the next part, what we will understand is what are the various types of strategies available. Yeah, what are the various strategies available which can be used implemented straight away. I'm sure out of this at least you can use it about 3 to 4. Definitely you can use it on a daily basis. Now, so let me take you through some of the strategies. Now it's a plain simple long call, which means a long call means I'm taking a long position by buying a call at a particular strike price. Now this presentation has three parts. One, I have explanation. I have point by point explanation in four different, first, what is the strategy? What are you doing? The next is actually what is the view, strategy view, and then how to implement the strategy. What is the upside potential? What is the downside risk? And then comments, whatever, if there is anything which is not told, maybe in terms of comment, you will get it. And then on top of it, you will actually see the payoff chart. This is exactly known as a payoff chart. Wherever there is a round mark, it's actually the strike price. You can understand, take it as a strike price. And the small lines are basically the break-even points. You always know where do you actually break even. And then it's very simple that, it's the rest of the things are self-explanatory. Of course, you have an Excel. You have an Excel also in which I've told what is a premium call, put your buying, what is a P&L. All those are explained. So we have a payoff chart, we have an Excel which will simply explain, and then definition on this side. This is how we are going to learn in this section. So first let's understand a long call. What do you mean by a long call? Actually here, when you do it, what is the strategy view? The buyer thinks that the market will rise significantly in the short term. This is not about the small movement which is likely to come, because we already understand the time value decay. When we know that concept, now if you're expecting there is going to be a big move in the market, typically, you can buy gold long or buy a long call. The implementation is call options are bought at a particular strike price. The more bullish the buyer is, the higher strike price he chooses. Possibly if the stock is currently trading at 100, if you feel that it is likely to go to about 120, you can take a 110 or 115 strike price, or even 120 strike price. The more bullish you think it is, the higher strike price you can choose. The upside potential definitely is unlimited. Yeah, even though the word looks attractive, but it says unlimited. But the downside risk is limited to the premium paid. Whatever premium you have paid, it's only limited to that extent. You don't have any other obligation. If the market expires or remains below or at the strike price, at the comment, if the market does little, if that doesn't move much, then your value of the position will decrease as the option time time value falls. That's the time value decay. Even if it is above strike price, it's going to come down, it's going to tumble down because of the time value decay. This is about the long call. This is the way basic vanilla. Anyone would just buy a call if they thinks bullish about the market. Now next, let's look at a long put, just opposite. What exactly, here you again have a payoff chart, as you can understand, and whatever is the premium you are paying, the P&L, how exactly it works. Now it is just to buy a put option means you are bearish. When you're bearish, when you're thinking there is a big significant downward move, you're going to buy a put. Now put option is bought with the strike price, again indicated at A, and then the more bearish the trader is, the lower strike price he chooses. Now at 100, if you feel that it's going to crash to 80 rupees, if that is your view, I'm just saying, if that is your view, you can take up a 90 or a 90 or an 85 strike price. Any of these strike price you can choose, or even 80, you can choose these strike prices. The upside potential. The upside, definitely the profit is unlimited, but the downside is limited to the premium paid. This we have already understood, except for the risk of time value decay. There is a risk of time value decay. Even if the market does little, the value of the position will decrease as as the option time value decreases. So this is about the buying a call or buying a put. Now let's move ahead and see some of the things. Now, covered call. When do you think that you should be using a covered call? Now, here is the payoff. As you can see clearly here, these are some of the strategies. This is strike price as well as the calculations are given here. Now, hold the stock and buy call options. Now you have a portfolio. Now you have a portfolio, you're not sure of what you want to do with your portfolio, but you can try and collect some premium or do something, with options. What do you do? The trader holds the stock, but does not think the stock will rise in the short term, or that stock will be neutral. So income can be gained by selling call option against stock holding. You are selling the call option by holding the stock. Now, call options are sold. The number of call options sold will be determined by the investor's market view and size of the stock holding. Now, what is the upside potential? Upside potential is limited by selling calls. The investor writing of the potential of the stock position. Maximum profit is the strike minus the market price plus the premium received. Whatever you have received, the premium which you have received, that is the maximum profit. What is the downside? Yeah, large, similar to that incurred with ordinary stock ownership, only offset, partially by the fixed, by the option premium received. The main loss could be the opportunity loss. Now, what you thought it could be neutral, but if the market there is a sudden move, then definitely you lose opportunity. Definitely you would be losing the opportunity. This is about the covered call. So how do you do it? Basically, you choose a strike price, and at a higher strike price, you choose a higher strike price, and you sell and collect the premium. Yeah, if the market remains there, it's like, you're gaining some return. Otherwise, if stock moves up, you obviously have to sell the stock. You obviously have to sell the stock. You know, that's how it works basically. So then let's look at the next. The next is actually a bull spread. Now, bull spread is something like buy and sell call options with a different strike price. Yeah, here you are going to buy and sell a call option with different strike price. Now, what do you mean by that? Here, basically you are bullish. You are bullish about the market. How do you implement it? First, call option is bought with a strike price. At a particular strike price, call option is bought. Another call option is sold with a strike price of P. Yeah, a different strike price. You're actually selling a call option. Now, producing a new initial debit. There could be an initial debit. There could be, which means what you receive could be less than what you actually pay as a premium. So maximum profit if market at expiry is above the higher strike, whichever the higher strike you have sold, it's about that. Now, downside risk, whatever is the net initial debit for the calls, and maximum loss at the expiry if the market is below lower strike price. Now, the time value erosion not too significant due to balanced position. Remember, you have also sold a call. You also sold a call as well as you bought a call. So somewhere it actually nullifies. Both are working in your favor. Both are actually working in your favor. Now, let's look at a long straddle. As the name suggests, you buy a call option and a put option with the same strike price. At 100 rupees strike price, I also buy a call as well as I put. Here that, the view is neutral. The trader thinks that the market may be very volatile in short term, but he is not sure of which direction. Now, let's see, there is a result which is coming up. Let's see, there is major announcement which is going to come up, reform which is going to come up, a policy announcement which is going to come up. You're not sure how the market will react, whether the market will react bullish or bearish, you are not sure. What do you do at that time? You actually try and do a long straddle where you buy a call and a put option at the same strike price. How do you implement it? Call option and put option are bought with the same strike price, usually at the money. Usually at the money. Unlimited. What happens to the upside? Upside is unlimited as long as you're covering both the premiums. As long as you're covering, as you can see here, until in this it's very clear. You have this break-even period. You have this break-even. You don't make until then. Only if the market exceeds beyond that level. then you make money. What's the downside risk? It's limited to the two premiums paid. If the trader would like to decrease premium, try strangle. We are going to understand what exactly is a strangle. Okay, as we go ahead, we'll also understand what a strangle is. Now, position lose value, with time as the time passes, because again, this is also subject to time value decay. This option is also, which is whatever is going to happen in the next 2-3 days, then it's worthwhile, not otherwise. Then this position will not be worthwhile. Now, after straddle, what do we have? Strangle. As I told you, we're trying to understand what exactly is a strangle, long strangle. Now, here you buy a call option and a put option with different strike prices. Remember, in straddle, what we did? At the same strike price we bought. Now we are buying at two different strike prices. What happens again? The view is neutral, but how do you implement the strategy? Yeah, put option is bought with a strike price and call option is bought with a strike B. Yeah, you buy a call option and a put option with different strike prices. This is long strangle. Now, again, upside potential is unlimited should the market fall or rise greatly. Yeah, downside risk, it's limited to two premiums paid. But if the trader would like to reduce the improvement, there should be a short butterfly. They should try a short butterfly. Now, position loses value with passage of time as the time value decreases on options. As you all know, it's the same risk which you're carrying. Now, moving on, let's try a long butterfly. Now, this involves several positions. As you can see from the chart here, it involves several positions here. First, the strategy is, why do you do it? Even your position is neutral. You're not expecting a big volatility. You're not expecting much to happen, but market to remain range bound. What do? You buy a call option with lower strike price and a higher strike price. Okay, and also sell a call and put option with medium or same strike price. So these are the various positions you are taking. You're shorting a call, you are going long on a call, you're going long on a put, and you're shorting a put also. The chart explains clearly here what happens, like, put option with a low strike price, but and straddle with strike A is sold with a call option with a higher strike price. Now, the upside potential is definitely limited. Downside is also limited. You are curbing the downside also. So this can be difficult to execute. This involves a lot of calculations. This involves a lot of calculation and understanding, and it can be difficult to execute in a short period of time. Or quickly, you cannot execute this project. Um, quickly, you cannot execute this strategy in the market. Okay. Now we come to long strip. Now, what is long strip? Here, the strategy is to buy a call option and two put options with the same strike price and the same expiry date. What do you mean? Why are you trying to do this? Here, the trader thinks that, that market will be volatile, but price is likely to decline. So he wants to get that extra advantage with the put, actually buying an extra put. Now, call option and two put options with the same strike price is bought. Like upside potential or money making potential is unlimited, but downside is limited. As you're only buying, so it's limited. Now it may be difficult. Again, it may be difficult, at any given point of time when you're sure, when you're uncertain, when you're certain of what you are seeing in the market, then definitely this position can be taken. Now, after long strip, what we're understanding is the strap. How does the strap work? Now, here you are buying two call options and a put option with the same strike price and expiry date. Now, the trader mildly thinks that the market will be volatile, but the price is unlikely to decline. Now, he wants to get advantage of this call, so he buys a double call and a single put. Now, both upside and downside is actually limited. The risk is actually limited, but it might be a little difficult. Only when you are certain that this action is likely to happen, you need to implement this. Now we come to some of the now we come to the shorting. This is all about buying. Most of the things which we discussed currently were all buying. Now about shorting. Now whether it is a call or a put, what happens when you short? You know that it is not just the premium you pay. You actually pay the margin which you have to pay, whatever the margin that is stipulated, you will have to pay the margin. Now here we have again the same system of a payoff chart which you can understand. You can go in depth and understand the payoff chart, which I'm also going to show you on a live basis. Using Sensible, I'll be showing you. What do you do here? You actually sell a call option. So which means you are bearish. The view is bearish. How do you do it? Call option is sold with a strike price A. The trader is very certain of his view that the money that at the money position should be sold. If less certain, then out of the money one should be sold. Yeah, it's at the money or out of the money could be sold. Now the position upside potential is limited to the premium received. Whatever premium you have received, that is the maximum profit you can make. So downside risk is unlimited. Losses on this position will worsen as the market rises. If trader has thinks that there is a downside risk, then he might be interested in a bear spread. He might actually cover it, or he might actually go for a bear spread. Now if the market loses little and the time passes, this helps as the short position gains whatever is the decay. Now by shorting, actually you are the beneficiary of time value decay. This is about shorting. Now let's look at shorting a put. Similarly, like if you are bearish, you would short a call. If you are bullish, you would sell a put option. So implementation is very simple. Put options are sold with a strike price if the trader is very bullish. Then in the money, put should be sold. In the money, put should be sold. The upside potential is limited to the premium you have received, but the downside risk is unlimited. It's a high risk strategy. Now again, if you feel that you're going to lose, then you have to actually cover it. Use a cover call. Then you're actually minimizing your risk. Also remember, because you're shorting, you are actually taking advantage of the time value decay which this position might offer. Now, what do you mean by a spread? We were talking about pair spread, or we were talking about spread. How do I actually break down my risk? Now, buy and sell put option with a different strike price. Yeah, buy and sell put option with different strike price. Now if your view is bearish, then how does this work? Put option is sold at a particular strike price and another put option is bought with a different strike price, actually by producing a net initial debit, which means what you receive could be less than what you actually pay as premium. Now what is the upside risk? Actually upside potential, yeah, the put difference between the strike minus the initial debit, that is the upside price, maximum possible. Now downside risk is maximum profit if market expires below the strike price. Now again, time value erosion is not too significant because of a balanced position. You have actually balanced your position because both buying and selling is involved. Now what is a short straddle? Now we have seen straddle, strangle on the call. Or similarly, what do you mean by a short straddle? Here you sell a call option and a put option with the same strike price. You're going to sell both a call option and a put option with the same strike price when your view is actually neutral. If your view is neutral, how do you do it? It is limited to two premiums received. Whatever you're doing is actually limited to two premiums. That's the maximum potential. And then if the market expires exactly at the same price also, if the market expires at the same strike price also, as well as within the spread, you're going to make money. Downside risk is actually unlimited. Should the market fall or rise greatly? Yeah. So if the market does little, then the value of the position will benefit as the short position will gain in time. Yeah, with the time value decay, you will actually stand to gain. This is about the straddle. Now, similarly, look at when there are two different points. If you're not doing at the same strike price, if you're actually executing the same position at two different strike price, then it becomes a short strangle. Sell a put option at a given strike price and a call option with a higher strike price. It's not at the same strike price, it's at two different strike prices. Now, if your view is bearish, now put option is sold with the strike price A, and then call option is sold with a higher strike price. Now, upside potential is limited to the two premiums received. Now, the downside is actually should the market rise greatly or fall greatly, yeah, then obviously your the risk tend to increase. Now, if the market does little, then the time value position will benefit as the short position will gain in time value. Yeah, again, this you're taking actually benefit of the time value decay. uh, we will be doing all these strategies. We'll be doing all these strategies on, we'll be applying it in real time using the sensible. We'll exactly know how the payoff chart works, how exactly all these things work as the price moves, how it works. But this is just a concept which I'm trying to give you through this video. Now, there is something called a short butterfly. Now, here you buy a call option and a put option with a different strike price. You're buying a call option and a put option with a different strike price. This we have already seen. Now, investor mildly thinks that the market will be volatile. Yeah, but what happens? You put option is sold at a particular strike price, a straddle is bought with a strike, and then call options are sold with a particular strike. These are the three actions which is happening. Now, upside potential is limited, downside is also limited. Yeah, it might be little difficult to execute in a short period, or if you're not sure, uncertain. Now, coming to the last part, that is the short strip. Now, here you sell a call option and a put option at the same strike price with the same expiry date also, at the same expiry date also. Now, the trader is certain that the market will not be very volatile, but price is likely to rise. So in this case, what you do, it is limited to three premiums. Whatever if the profit is actually limited to whatever three premiums you have received. Okay, the downside is actually unlimited. There should the market fall or rise greatly. Now, the market does very little, that the value of position will benefit as the short positions gains. Any of the short positions will actually gain with the time. This we have seen. This is about the strip, and then we have the strip. Strip exactly is actually you're selling two call options and a put option with the same strike price and the same expiry date also. Now, these are some of the strategies which I've explained. Now, many of these, if not most of it, many of this we'll take back and practically try and put it in sensible and see how exactly it works. I hope these strategies, what you can do is, you can try and understand the terminologies and see various data available. And you can even try putting these strategies and see how exactly it works out in real time, which I'll be showing in my next video. Thank you so much, and thank you for staying with me in this part of the presentation.